Disclaimer.
What if the price on your screen isn't just wrong? It's legally irrelevant? Right now, silver is trading in two different worlds. In New York, it's a digital number at $103. In Shanghai, it's a physical reality at $114. This isn't just volatility, it's a structural divorce that's about to change how you own assets forever. On January 1st, China officially weaponized its silver supply, restricting exports to just 44 state-licensed firms. At the same moment, the DOJ launched a criminal probe into Fed Chair Jerome Powell, shattering the illusion of monetary independence. The market isn't reacting to news, it's reacting to a supply cliff. As a finance enthusiast, I don't care about the hype, I care about the plumbing. While inventories at the COMEX have dropped by 70%, the most dangerous part of this story isn't the shortage, it's the fine print. Tonight, as the Tokyo markets open, we are moving from price discovery to contractual reality. Let's look at the data. The exchanges don't want you to calculate. Something unusual is happening in silver markets right now, and understanding it requires looking at more than just price charts. While your screen shows silver trading around $103 per ounce as of Friday's close, that number tells only part of the story. To understand what's really going on, we need to look at what happened in early January and why it matters for how silver trades today. Think about the last time you tried to buy concert tickets for a sold-out show. The website says they're $75, but when you actually try to purchase them, you discover the only available tickets are going for twice that amount through resellers. The posted price and the price you actually pay have diverged. Something similar is playing out in silver markets right now, except instead of concert tickets, we're talking about a metal that's essential to solar panels, electronics, and increasingly, our entire technological infrastructure. On January 1st, 2026, China implemented export restrictions on silver that fundamentally changed global market dynamics. According to the Ministry of Commerce announcement from late October, companies wanting to export silver must now obtain government licenses. Only 44 firms made the approved list for the next 2 years, and they had to meet strict criteria, including annual production exceeding 80 tons and consistent export records from 2022 through 2024. This isn't a small policy adjustment. China dominates global silver refining, and according to industry analysts, Chinese exports represent somewhere between 60 and 70% of refined silver that moves across international borders. Let me put that in perspective. Imagine if one country controlled most of the world's oil refining capacity and suddenly required special government permission to ship refined fuel abroad. The official price might still reflect yesterday's easy availability, but anyone actually trying to fill their tank would quickly discover a different reality. That's essentially what's happened with silver, except the metal doesn't just go into investment products. It goes into the solar panels we need for clean energy, the semiconductors that power everything from phones to data centers, and the electric vehicles that represent our transportation future. According to data from the Shanghai Gold Exchange, physical silver trades, there have been occurring at premiums well above Western quoted prices. Some sessions in January saw physical transactions exceeding $114 per ounce, while the Western exchanges still quoted prices in the low 100s. That's not a small spread. That's a fundamental disagreement about what this metal is actually worth when you need to take delivery of it. Now, you might be wondering why this matters if you're just tracking silver as an investment. Here's where it gets interesting. For decades, most silver price discovery happened through futures contracts and exchange-traded products. These are paper instruments where relatively small amounts of actual metal back enormous trading volumes. Think of it like a bank. Most of the money deposited doesn't sit in the vault. The bank lends it out, confident that not everyone will demand their cash at once. The system works beautifully until suddenly everyone shows up wanting physical currency. Data from COMEX, the primary American silver futures exchange, shows something noteworthy happened in mid-January. According to market observers tracking warehouse receipts, January 23rd saw 2,804 delivery notices in a single day. For context, that represents about 14 million ounces of silver that contract holders wanted, delivered as physical metal, not just rolled into the next month's contract. The January contract saw unusual levels of delivery demand compared to typical minor delivery months. Between early and mid-January, approximately 33 million ounces were withdrawn for physical delivery over just 7 trading days. That represented roughly 1/4 of COMEX's registered inventory disappearing in a week. Registered inventory is the critical number because it represents metal that is actually available for delivery against futures contracts. The rest of the silver in COMEX warehouses is classified as eligible, meaning it meets exchange standards, but isn't currently pledged for delivery. Here's what makes this particularly significant. According to data compiled by precious metals analysts, COMEX registered silver inventories have declined by more than 70% since their 2020 peak. We went from 346 million ounces of registered inventory down to levels that, in late 2023, hit just 82 million ounces. While inventories have fluctuated since then, the overall trajectory shows a system under increasing stress when contract holders actually want their metal. At the same time this inventory drawdown was happening, something else changed in the broader financial landscape. On January 11th, Federal Reserve Chairman Jerome Powell released a video statement revealing that the Department of Justice had served the Federal Reserve with grand jury subpoenas. The investigation relates to Powell's testimony before the Senate Banking Committee last June regarding cost overruns on the Federal Reserve headquarters renovation project. Powell stated clearly in his video message that while the investigation officially concerns building renovations, he views it as part of broader pressure from the administration regarding interest rate policy. Now, I need to be clear about something. The DOJ investigation of Powell and the stress in silver markets are separate events. We can't draw a direct causal line between them. But markets don't always need direct causation to react. They respond to uncertainty. When the independence of the Federal Reserve gets called into question through a criminal investigation, institutional traders who make decisions about commodity positions start asking questions they didn't have to ask before. Questions like, what happens to dollar stability if monetary policy becomes politically directed? How do we price assets if the Fed's credibility gets undermined? Where do we park value if the traditional safe havens become less safe? According to analysts at Evercore ISI, who released a note to clients on the Powell investigation, markets were applying a higher risk premium to United States assets following the announcement. That's financial market speak for. Investors demand better returns to compensate for increased uncertainty. When that happens, you often see what analysts call a flight to real assets. Physical gold, physical silver, real estate, commodities you can actually touch and store. This brings us to another critical indicator that something fundamental has shifted. Silver lease rates have spiked to levels that precious metals veterans describe as unprecedented. Lease rates represent the cost someone pays to borrow silver for a period of time. Under normal market conditions, 1-month silver lease rates hover around 0.3 to 0.5%. That's the range you'd expect when silver is readily available and the market is in balance. By early January 2026, those rates had climbed to around 8%, according to market data tracked by industry sources. During particularly volatile periods in September and October of 2025, some lease rates temporarily spiked above 30%. Think about what that means. Someone is willing to pay 8% annualized just to borrow silver for 1 month. That's not the behavior of a market with plenty of available metal. That's the behavior of participants desperate to secure physical inventory to meet contractual obligations. Bruce Ikemizu, former Tokyo Precious Metals Banking Director and now head of the Japan Bullion Market Association, captured the situation in stark terms when silver briefly traded above $50 per ounce last October. "Silver squeeze is on," he said. "This is serious." The lease rate that day had nearly tripled from already elevated levels to reach more than 19% per annum before pulling back. So what does all this mean for someone trying to understand silver markets in late January 2026? It means we're watching a market in transition. For years, silver traded primarily as a financial asset with an industrial component. Price discovery happened mostly in New York and London through futures contracts and over-the-counter trading. Physical delivery was available, but relatively rare. Most traders simply rolled contracts forward or settled in cash. That system is showing significant strain. China's export restrictions have effectively fragmented the global silver market into regions with different access to physical metal. Industrial consumers, particularly in electronics and solar manufacturing, are increasingly bypassing traditional exchanges and buying directly from producers or approved exporters at whatever price secures supply. Investment demand has intensified as both Eastern and Western buyers seek physical metal rather than paper promises. The result is what market participants are calling a two-tier market. There's the price you see quoted on financial terminals, reflecting futures contracts and exchange-traded funds. Then there's the price you actually pay when you need physical metal delivered to a specific location by a specific date. That spread between paper and physical has widened to levels that suggest the traditional pricing mechanism is not functioning the way it used to. This isn't necessarily about the silver price going up or down in the immediate future. Prices remain volatile and could move in either direction on any given day. What we're watching is something potentially more fundamental, a repricing of silver based on its physical availability rather than its financial trading volume. In a world where the metal is increasingly viewed as strategic, essential for industrial applications, and subject to export controls by major producing nations, the old rules about price discovery may no longer apply. For anyone holding silver investments, whether in coins, bars, or exchange-traded products, understanding this shift matters. The gap between what your statement says your silver is worth and what you could actually get by selling it and buying physical metal has become a real consideration. That's not a reason to panic, but it is a reason to understand the mechanics of what you own and how different silver products actually work when markets experience stress. In the next part, we'll dig into those mechanics. How do exchange-traded funds really work when physical metal gets scarce? What exactly does that CME rulebook say about delivery and settlement? And what do those elevated lease rates tell us about what's happening behind the scenes in the wholesale silver market? Understanding the plumbing of the system is essential to understanding the risks and opportunities ahead. To understand what's happening in silver markets, we need to look under the hood at how these financial products actually work. Most people who own silver through investment products have never read the prospectuses or exchange rulebooks that govern what they actually own. That's not a criticism. These documents are dense, technical, and written in legal language that makes your eyes glaze over. But when markets experience the kind of stress we're seeing now, those details matter enormously. Let's start with exchange-traded funds, the most popular way Americans invest in silver. The iShares Silver Trust, which trades under the ticker SLV, is the largest silver ETF in the world. As of early January 2026, it held approximately 650 million ounces of silver, representing roughly 7 months of global mine production. When you buy shares of SLV, you're buying a fractional interest in that pool of silver held in trust. At least, that's how it's supposed to work. The prospectus for SLV, which is publicly available and runs to dozens of pages, contains language that most investors never read. On page 6, there's a section about the trust's obligations. It states that in certain circumstances, the trust may be unable to acquire sufficient silver to create new shares. More importantly, it discusses scenarios where authorized participants, the large financial institutions that create and redeem ETF shares, may be unable or unwilling to provide physical silver for the creation process. Here's how ETF creation normally works. When demand for SLV shares increases, authorized participants buy physical silver, deliver it to the trust's custodian, and receive newly created ETF shares in return. Those shares then trade on the open market. Redemption works in reverse. Authorized participants turn in ETF shares and receive physical silver. This mechanism keeps the ETF price closely tracking the spot price of silver. If the ETF trades at a premium to the metal's value, arbitrageurs can profit by creating new shares. If it trades at a discount, they can profit by redeeming shares for metal. But what happens when physical silver becomes difficult to source? According to the prospectus, several things can occur. The trust may suspend the creation of new shares. The ETF price may decouple from the spot price, trading at significant premiums or discounts. In extreme scenarios, authorized participants may simply refuse to participate in creation or redemption, effectively breaking the arbitrage mechanism that keeps everything in sync. We've seen hints of this stress in recent months. During September 2025, when silver prices were climbing rapidly and lease rates spiked above 30%, some ETF analysts noted unusual spreads between the ETF price and net asset value. These weren't permanent dislocations, but they were wider than normal and lasted longer than typical intraday variations. They suggested that even the largest, most liquid silver ETF was feeling the strain of a market where physical metal was harder to source. Now let's talk about futures contracts and the rules that govern them. The CME Group operates COMEX, where silver futures trade. These contracts represent agreements to deliver or take delivery of 5,000 ounces of silver at a specified future date. Most futures contracts never result in physical delivery. Traders close their positions before the delivery period, either taking profits or losses, and move on. Physical delivery is the exception, not the rule. However, CME rules do address what happens when delivery becomes problematic. Rule 701, which deals with force majeure and trading halts, gives the exchange broad authority to respond to extraordinary circumstances. According to the rulebook, if the exchange determines that a force majeure event has occurred, defined as circumstances beyond reasonable control that make performance commercially impracticable, they can take various actions. These include mandating cash settlement instead of physical delivery. Let me be clear about what this means, and more importantly, what it doesn't mean. Yes, the exchange has the legal authority to settle contracts in cash rather than metal under extraordinary circumstances, but this isn't some secret trap door that gets triggered automatically when inventories get low. It's an emergency provision that the exchange would invoke only under extreme circumstances, and doing so would have significant legal and reputational consequences. Historically, COMEX has suspended trading or altered contract terms during true crisis situations. In 1980, during the Hunt brothers' attempt to corner the silver market, the exchange implemented Silver Rule 7, which prohibited new long positions except for liquidation purposes. That was an extraordinary intervention. During an extraordinary manipulation attempt, the exchange didn't lightly decide to change the rules mid-game. They did it because the alternative was a complete market breakdown. Could something similar happen today? Theoretically, yes. If physical inventories became so depleted that the exchange couldn't facilitate orderly delivery, they might mandate cash settlement. But consider what that would actually require. It would require COMEX registered inventories to fall to levels where they literally couldn't honor delivery obligations. It would require a formal declaration that physical delivery had become commercially impracticable. And it would open the exchange to lawsuits from contract holders who expected physical metal. The more likely scenario, based on how exchanges typically operate, is gradual adjustment rather than sudden rule changes. We'd see margin requirements increase, making it more expensive to hold positions. We'd see delivery fees and premiums rise. We'd see exchanges encouraging cash settlement through various incentives while still allowing physical delivery for those who insist on it. These are the tools exchanges use to manage stress without breaking the fundamental contract they offer to market participants. Speaking of stress indicators, let's return to those lease rates we mentioned in part 1. When 1-month silver lease rates climb from 0.5% to 8%, what's actually happening? To understand this, you need to know how the wholesale silver market works. Large banks and bullion dealers maintain inventories of physical silver. They use this inventory to facilitate various transactions, fulfilling delivery obligations, providing metal for industrial customers, supporting their market-making activities. When a bank needs more silver than it currently has on hand, it can borrow silver from another institution that has excess inventory. The lease rate is the cost of that borrowing. Under normal conditions, there's plenty of silver available to borrow, so lease rates stay low. But when many institutions simultaneously need silver, those rates spike. It's basic supply and demand. The institutions that own physical silver know that others desperately need it, so they charge accordingly. An 8% lease rate tells us that silver has become significantly harder to borrow. It doesn't tell us the system is about to collapse, but it does tell us the system is under more strain than usual. According to precious metals analysts at TD Securities and other major banks, these elevated lease rates create a self-reinforcing dynamic. When it's expensive to borrow silver, short sellers face higher costs to maintain their positions. Some may choose to close those positions, which requires buying silver, which can drive prices higher. Higher prices and higher lease rates together make physical silver more valuable to hold and less attractive to lend out, which can keep lease rates elevated even after the initial spike. There's another layer to this that's worth understanding. The wholesale silver market operates globally but concentrates in a few key locations. London, through the London Bullion Market Association, has traditionally been the world's central hub for physical silver trading and storage. New York, through COMEX, is where most futures trading occurs. Shanghai has emerged as the dominant Asian center. These markets are connected through arbitrage. When silver trades at different prices in different locations, traders profit by buying where it's cheap and selling where it's expensive, which theoretically keeps prices aligned. But arbitrage only works when you can actually move metal between locations. China's export restrictions have made that significantly harder. According to the list published by China's Ministry of Commerce in December 2025, only 44 companies are authorized to export silver under the new licensing regime. These companies must meet stringent requirements including minimum production capacity, established export history, and financial stability criteria. The list includes major state-owned enterprises and some private firms, but it excludes many smaller exporters who previously participated in the market. The practical effect is that silver physically located in China largely stays in China unless one of these approved exporters handles the transaction. That silver is available for China's domestic industrial consumption, which is substantial given the country's dominance in solar panel manufacturing and electronics production. But it's not readily available for Western markets. This creates what analysts call market segmentation. The global silver market isn't really global anymore. It's fragmented into regions with different supply dynamics and potentially different prices. Some industry observers point to historical precedents. China implemented similar export controls on rare earth elements starting around 2010. Those controls didn't eliminate rare earth exports, but they did make them more expensive and less reliable. Western manufacturers that depended on Chinese rare earths faced supply uncertainty and price volatility. Many responded by seeking alternative sources, investing in recycling technologies, or redesigning products to use less rare earth content. It took years for markets to adjust. Silver presents a similar but more complex challenge because it's both an industrial metal and a monetary metal. Industrial users need silver for manufacturing and can't easily substitute other materials in many applications. Solar panels, for instance, require silver paste for the photovoltaic cells, and no viable alternative currently exists at scale. Investment demand for silver as a store of value adds another layer of buying pressure that does not exist for most industrial metals. This brings us to a critical question. What does it mean to own silver in today's environment? If you hold physical coins or bars in your possession, the answer is straightforward. You own metal that you can see, touch, and store however you choose. But most silver investment happens through financial products: ETFs, futures contracts, allocated storage accounts, unallocated storage accounts, and various certificates and receipts. Each of these products has different characteristics when markets experience stress. Allocated storage means specific bars are set aside in your name. If the storage facility fails, you theoretically have a claim on those specific bars. Unallocated storage means you have a claim on silver from a general pool, similar to a bank account. You don't own specific bars, you own a contractual promise to deliver silver. Futures contracts are yet another step removed. They're agreements to deliver or take delivery at a future date, but most never result in physical transfer. The prospectuses and contracts that govern these products contain language about what happens under various stress scenarios. Some allow for cash settlement, some allow for delays in delivery, some have force majeure clauses that excuse performance under extraordinary circumstances. Very few guarantee that you'll be able to convert your financial claim into physical metal at the quoted price on any given day. Does this mean these products are fraudulent or worthless? Not at all. Under normal market conditions, they work exactly as intended. ETFs track silver prices closely. Futures contracts allow for price discovery and hedging. Storage accounts provide convenient ways to own silver without the logistics of personal possession. The question isn't whether these products work. It's whether investors understand how they work when markets stop being normal. Market participants right now are essentially running a stress test on these various products. As physical premiums widen, as lease rates stay elevated, as delivery requests increase, we're learning which products maintain their functionality and which ones reveal limitations. This isn't happening in a laboratory. It's happening in real time with real money. For anyone considering silver investments or currently holding them, understanding these mechanics matters more now than it did a year ago. The questions you need to ask are different. It's not just what's silver going to do tomorrow? It's what exactly do I own? What are the counterparty risks? What happens if physical delivery becomes constrained? How quickly can I convert this financial claim into physical metal if I need to? In the final part, we'll look at what various analysts and market observers are saying about where things go from here, examine some historical precedents for markets under stress, and discuss practical considerations for anyone trying to navigate this environment. The goal is not to tell you what to do. That's a personal decision based on your individual circumstances. The goal is to help you understand the landscape so you can make informed choices. When markets experience significant structural changes, analysts and investors naturally look for frameworks to understand what might happen next. With silver, there are several analytical lenses people use to evaluate where prices might go. It's important to understand these frameworks not as predictions, but as different ways of thinking about value. One of the most commonly cited metrics is the gold to silver ratio. This measures how many ounces of silver it takes to buy 1 ounce of gold. As of late January 2026, with gold trading near $5,000 per ounce and silver around $103, that ratio sits at roughly 48 to 1. In other words, it takes about 48 ounces of silver to equal the value of 1 ounce of gold. Historical analysis shows this ratio has varied enormously over time. In the late 1800s, when both metals served as currency in many countries, the ratio was often fixed at around 16 to 1 by government decree. During the 20th century, after the abandonment of precious metal currency standards, the ratio fluctuated much more widely. It hit 10 to 1 during silver's peak in 1980, reached 100 to 1 during periods when silver was particularly depressed, and has averaged somewhere between 50 and 60 to 1 over recent decades. Some analysts argue that when the ratio is elevated, meaning silver is cheap relative to gold, it tends to compress over time as silver catches up. They point to bull markets in precious metals where silver outperformed gold significantly, bringing the ratio down to 30 or even 20 to 1. Based on this framework, if gold is at $5,000 and the ratio compressed to 40 to 1, silver would theoretically trade around $125 per ounce. But here's what's critical to understand. The gold-silver ratio is a descriptive tool, not a predictive one. It tells us about the historical relationship between these metals. It doesn't tell us what that relationship must be in the future. Markets don't respect historical averages just because they're historical. The ratio could stay at 48 to 1 indefinitely. It could widen to 60 or 80 to 1 if gold continues rallying while silver faces headwinds, or it could compress as some analysts expect. All of these outcomes are possible. Other analysts focus on silver's industrial fundamentals. According to the Silver Institute, an industry research organization, global silver demand has exceeded supply for 5 consecutive years through 2025. Industrial applications account for roughly half of total silver demand, with solar photovoltaics representing the largest single growth sector. The Silver Institute estimated that solar panel manufacturing consumed approximately 232 million ounces in 2024, up from previous years as global solar installation accelerated. This structural deficit, where annual demand exceeds annual supply, gets financed through existing above-ground stocks. Those stocks, accumulated over decades of mining, get drawn down each year to make up the shortfall. Eventually, this process has to resolve somehow. Either prices rise enough to reduce demand or stimulate new supply, or technological substitution reduces silver consumption in key applications, or previously economic stockpiles get mobilized back into the market. The bullish case for silver emphasizes that the deficit CA can't continue forever and that industrial demand is relatively price inelastic, meaning manufacturers will pay higher prices rather than halt production. The bearish case points out that high prices incentivize both new mine supply and technological substitution, and that industrial demand could weaken if economic growth slows. Both perspectives have merit. Which one proves correct depends on variables we can't know in advance. There's also a monetary perspective on silver that gained prominence as prices rallied through 2025. Some investors view silver, like gold, as a hedge against currency debasement and financial system instability. In this framework, silver's value is not primarily determined by industrial supply and demand, but by its role as an alternative to fiat currency. When confidence in central banks and government finances weakens, demand for physical precious metals increases regardless of industrial fundamentals. The Powell investigation we discussed earlier fits into this narrative for some observers. They see criminal investigations of the Federal Reserve Chairman, regardless of the stated rationale, as evidence of the Fed's independence being compromised. If monetary policy decisions become subject to political pressure rather than economic data, the argument goes, the dollar's credibility as a stable store of value diminishes. This could drive both domestic and international investors toward hard assets. However, it's equally plausible that the investigation resolves without significantly impacting Fed policy, that Powell completes his term in May and is replaced through normal processes, and that any temporary uncertainty fades as new leadership establishes credibility. Markets have absorbed plenty of political drama over the years without fundamental breakdowns in the monetary system. Let's look at some historical precedents for markets experiencing the kind of stress we're seeing in silver. The nickel market in March 2022 provides a recent example. Nickel prices on the London Metal Exchange spiked from around $25,000 per ton to over $100,000 in a matter of days as a major participant faced a massive short squeeze. The LME responded by halting trading, canceling trades that had occurred during the spike, and implementing new position limits. It was a controversial decision that revealed the tension between maintaining orderly markets and honoring executed contracts. The Hunt brothers' silver manipulation in 1979 and 80 showed what happens when concentrated positions meet exchange rule changes. As we mentioned earlier, COMEX implemented Silver Rule 7 to prevent further accumulation using leverage. Silver prices collapsed from their peak of $49 per ounce to below $11 within months. Many investors who bought near the top, expecting continued appreciation, faced devastating losses. The broader precious metals bull market from 2001 to 2011 offers another data point. Gold rose from around $250 to over $1,900 per ounce. Silver rose from around $4 to $48, outperforming gold significantly as the gold-silver ratio compressed. Then both metals entered a multi-year bear market, with silver eventually falling back below $14 by the end of 2015. Investors who bought during the mania and failed to take profits gave back years of gains. What these historical examples share is that periods of intense market stress tend to resolve one way or another. Sometimes resolution comes through price adjustments that rebalance supply and demand. Sometimes it comes through regulatory intervention. Sometimes it comes through technological change or shifts in investor sentiment. Rarely does a market stay in a state of extreme stress indefinitely. For silver specifically, in 2026, there are multiple possible paths forward. In one scenario, elevated prices incentivize new mine production, encourage recycling, and trigger technological substitution in industrial applications. China's export restrictions create a two-tier market where Chinese domestic prices differ from international prices. But both markets find equilibrium at new levels. Physical premiums narrow as the market adjusts to the new supply reality. Lease rates decline as banks build inventories and delivery stress eases. In another scenario, industrial demand proves more resilient than expected. New supply takes years to develop, and China maintains or tightens export restrictions. Physical premiums remain elevated or widen further. More investors demand physical delivery, stressing the ETF and futures mechanisms. Cash settlement becomes more common. The gap between paper and physical markets persists or grows. A third possibility involves some kind of policy response. Governments concerned about silver availability for strategic industries might implement their own stockpiling programs or export restrictions. This could fragment markets further. Alternatively, international negotiations might ease trade restrictions if the economic costs become severe enough. The LME and COMEX might adjust contract specifications or margin requirements to reduce stress on delivery mechanisms. We genuinely don't know which path markets will take. Anyone claiming certainty about what happens next is either fooling themselves or trying to fool you. What we can do is understand the forces at play and the mechanisms through which they might resolve. So what are the practical considerations for someone navigating this environment? First, understand what you actually own. If you hold a silver ETF, read the prospectus. Understand the circumstances under which creation and redemption might be suspended. Know whether your shares are held in a taxable account or a retirement account, because that affects your ability to move quickly if needed. If you hold futures contracts, understand the delivery process, the costs involved, and the storage logistics if you actually took delivery. Most people trading futures have no intention of taking delivery and no practical ability to store 5,000-ounce contracts. They're purely trading the price movement. If that's you, recognize that you're participating in the paper market, not the physical market, and those markets may behave differently under stress. If you hold physical silver, understand the premiums you'd face buying more or the discounts you'd face selling. The spread between dealer buy and sell prices can be significant, especially for smaller quantities or less common products. During periods of high demand, those spreads widen. What you paid for silver and what you could sell it for today might differ by 10 or 15%, even if the spot price hasn't moved. Consider counterparty risk across all your holdings. Every financial product involves trusting someone else to honor their obligations. ETFs trust custodians to hold the metal. Futures contracts trust the exchange to facilitate delivery. Allocated storage trusts the vault operator. Even physical silver held at home trusts your security measures against theft. There's no such thing as zero counterparty risk. The question is which counterparties you're comfortable trusting and under what circumstances. Think about liquidity, not just whether you can sell something, but whether you can sell it quickly at a fair price. Physical silver is relatively illiquid compared to stocks or bonds. You can't sell a silver eagle at the click of a button for the spot price minus a small commission. You need to find a dealer, get a quote, ship the metal, or visit in person, and accept whatever bid they're offering that day. During market stress, that process becomes harder and spreads widen. Understand the tax implications of your holdings. Physical silver held for more than 1 year gets taxed as a collectible at a higher capital gains rate than stocks in the United States. Silver held in an IRA or 401k has different tax treatment. Trading futures generates different tax forms than selling ETF shares. These details matter when you're calculating actual after-tax returns. Be realistic about your own emotional tolerance for volatility. Silver prices in January 2026 have already demonstrated they can move 5 or 10% in a single day. That volatility works in both directions. If watching your portfolio fluctuate by thousands of dollars in an afternoon is going to cause you to make impulsive decisions, perhaps a smaller position size makes sense. The best investment strategy is one you can actually stick with through inevitable volatility. Consider the role silver plays in your overall financial picture. Is it speculation, hoping to profit from price appreciation? Is it insurance against monetary system instability? Is it diversification to reduce correlation with traditional assets? Your answer to that question should influence how much you hold and in what form. Insurance doesn't need to be profitable every year. It just needs to be there when you need it. Speculation requires different position sizing and risk management. Watch for actual supply and demand signals rather than just price movements. Are industrial consumers struggling to source material? Are refiners operating at full capacity? Are premiums on physical products widening or narrowing? These indicators tell you more about market fundamentals than daily price fluctuations driven by trading activity. Pay attention to regulatory and policy developments. China's export restrictions didn't appear overnight. They were announced months in advance. Other governments might implement similar policies or respond with trade measures. The CME and LME continuously evaluate their rules and may adjust them if market conditions warrant. Staying informed about these structural factors matters more than trying to predict tomorrow's price. Finally, maintain appropriate skepticism about forecasts and predictions. The silver market has generated countless predictions over the years, from various analysts, newsletters, and promoters. Some predicted silver at $500 per ounce. Others predicted it falling to $10. Very few have consistently predicted anything accurately. The future is uncertain, and anyone claiming to know exactly where prices are headed is guessing, even if they're guessing with sophisticated analysis. What we've watched unfold in early 2026 is a market in transition. China's export restrictions, elevated lease rates, inventory drawdowns, and widening physical premiums all point to a silver market operating under more stress than it has in years. Whether this stress resolves through higher prices, through market adjustments, through policy changes, or through some combination remains to be seen. The opportunity in understanding these dynamics isn't to make a perfect prediction. It's to navigate whatever comes next with your eyes open. Know what you own, understand the risks, recognize the limitations of various products and frameworks, and make decisions appropriate for your individual circumstances, rather than following the crowd. Markets have a way of humbling people who become too certain about anything. The investors who survive and thrive over the long term are not the ones who perfectly predict every move. They're the ones who understand what they don't know, manage risk accordingly, and avoid letting either fear or greed drive their decisions. Silver's story in 2026 is still being written. Whether you participate, how you participate, and what risks you're willing to take are personal choices. The goal of understanding the structural changes, the market mechanics, and the various perspectives isn't to tell you what to do. It's to give you the knowledge to make informed decisions for yourself. That's the real edge in any market. Not perfect information about the future, which no one has, but clear understanding of the present, which anyone can develop if they're willing to look past the headlines and examine how things actually work.